Welcome to this my 7th update for my data for 2019. And in this update, I want to talk about something that I think draws strong emotions, and that is debt. Debt is a hot button issue. There are people on one side of the spectrum who view it as an unmixed good. On the other side of the spectrum, there are people who feel that it is something that companies should avoid at all costs. The truth, as is usually the case, falls somewhere in the middle. So in this particular session, I'd like to focus first on how debt loads vary across companies, across industries, across regions, kind of give you a sense of what the data tells me. But I also want to look at two changes, one that's already happened and one that's coming down the pike. The first was a change in the US last year in the corporate tax rate from 40% to 25%, which I'm going to argue should have had large consequences for how much debt US companies carried. So we're going to look at whether that happened. The second is a change that's coming this year, and that's a change in how leases are treated by accountants. Historically, accountants have cut leases a free pass. A company that used leases has generally been able to evade the responsibility of showing those commitments as debt and instead showed it as operating expenses. Finally, in 2019, accountants are going to come to their senses and do the right thing, which is to treat lease commitments as debt. I'm going to give you a preview of how that change is going to affect margins and returns on capital and profitability and why. Let's start with some basics. When you think about a company and you think about the ways you can fund a company, there are ultimately only two ways. You can use debt or you can use equity. And if you think about the pluses and minuses of using debt as opposed to equity, on the plus side, you have two big benefits. The biggest benefit of all is a tax benefit. Across much of the world, the tax code is tilted towards debt. In what sense? Interest expenses are tax deductible, but cash flows to equity investors, dividends and buybacks, have to come out of after-tax cash flows. The second benefit, and this is a milder benefit, is there are some companies, especially where the managers don't own much equity in the company, where borrowing money can make the company more disciplined in the way it picks projects. It increases the consequences to being sloppy. Tax benefits and added discipline. On the other side of the equation, there are two costs. The first is when you borrow money, you increase the likelihood that you can fail to make the payments that you're contractually required to. And if you do so, you could go into distress and essentially give up control of the company. That's bankruptcy costs. The second is when you invite lenders into a company, you are in fact inviting a group of investors with very different incentives than your equity investors. Your equity investors might want to take risk, your lenders might not. You're saying, who cares? Lenders, when they come into a firm, will put constraints on what you can or cannot do. So if you're a company that values freedom, perhaps you shouldn't borrow money. So tax benefits and added discipline, bankruptcy costs and agency costs. Now here's what the tax code did in 2018 in the US, and you can see already why this should have consequences. It changed fairly dramatically. First, the highest corporate tax rate, the marginal corporate tax rate, was lowered from 35% to 21%. If you include state and local taxes, the marginal tax rate for U.S. companies in 2017 was 40%. It's now become about 25%. Second, there were restrictions that were put on how much interest expense a company could deduct. And while this is going to be phased out over a time, those interest expenses, if they exceed 30% of taxable income, will no longer get a tax benefit. Since the bankruptcy laws did not change, the benefits have dropped because of the change in the tax code. The costs remain the same. You would expect U.S. companies to now borrow less money. That's a conclusion I drew at the start of last year when the tax code had passed. Let's see whether the numbers back that up. Here in this table, I've looked at the total debt at the end of the third quarter of 2017, September 30th of 2017, and September 30th of 2018, which is the most recent data I have for most companies. And I'm looking at the change in the total debt, and I've broken this down by region. Across the world, companies increased debt. There are some parts of the world, like Australia and Eastern Europe, where you saw a drop in the debt load. The US, though, is what I want to focus on, because here's where the tax code changed. And as I said, I expected debt to go down. No, it actually went up. The debt as a percentage of market equity decreased, but the total debt increased. You see, how do you explain this? I generally don't take it on to myself to explain things that companies do, but there are three possible explanations. The first is inertia. I firmly believe that one of the strongest forces in corporate finance is inertia. Companies do what they're doing because that's what they've always done. So it's possible that it'll take a while for the change in the tax code to flow through to companies and how they borrow. So maybe we'll start seeing the effect in 2020, 2021, 2022. The second is corporate tax codes change all the time. Maybe people are uncertain about what future tax rates will be. I mean, you have a lot of populist stock in the air, where presidential candidates for 2020 are talking about how they want to raise taxes. Maybe that's holding companies back. Maybe they're concerned that corporate taxes will go back up again. And there's the third possibility. A lot of choices on debt seem to be driven by what I call illusory benefits or transient benefits. You're saying, what are you talking about? For instance, I've seen CFOs argue that debt is cheaper than equity because the interest rate you pay on debt is less than what you have to pay to your equity investors. It's a strange argument. By that notion, you should keep borrowing money till you're 99% debt. Debt is always going to be cheaper than equity because they're the first claimants on your cash flows. The second argument I've heard is debt will make your return on equity go up. That is technically true because if you borrow money and you have less equity at play, but your risk for equity should also go up. So your return on equity will go up, but so will your cost of equity. So maybe companies are borrowing money because debt looks cheaper still, at least from the perspective of looking at interest rates. On the other side of the equation, there are people who refuse to borrow money because they say, if I borrow money, my net income will be lower. That is true, right? Because you have interest expenses, but you also have fewer shares outstanding. On a per share basis, your earnings might actually be higher. The second is I've heard companies say they won't borrow money because they will lower ratings. S&P or Moody's will lower their rating. That is going to be true as well. So what? You'll have a higher cost of debt, but you might still end up with a lower cost of capital. On the transient side, you might have companies borrowing money because companies they're being charged too low an interest rate. Maybe their debt is subsidized. So you could actually have market forces misprice your debt or your equity, and maybe that's driving your debt and equity choices. Time will tell which of those explanations best applies for U.S. companies. Is it because it's just slow and it takes a while for it to flow through? Is it because companies are holding out, waiting to see whether the corporate tax rates stay low? Or is it because of illusory or transient benefits? We'll find out, because as you go through time, if you don't see a drop in debt ratios, it's either the illusory or the transient benefits, or maybe companies are just waiting to see what's going to happen. So now let's take another topic. I've talked about debt so far as if it's a given. But what separates debt from equity? To draw a contrast between debt and equity, let's see what the differences are. Debt gives you a contractual claim on the cash flows. It's preset. Equity is a residual claim. You get whatever's left over. Generally speaking, in much of the world, the payments you make on debt are tax deductible, but the payments to equity investors are not. If you get into trouble, debt holders get first claim on your cash flows, whereas equity investors are last in line. And finally, debt holders generally don't take a role in how the companies run, and equity investors do. But the key contrast between debt and equity is debt has a contractual claim on the cash flows, and if you fail to make that claim or meet that claim, bad things happen to you. You have to give up control, perhaps go into default, and perhaps turn over the company to the lenders. Using that definition of debt is actually very useful, because when you go into a balance sheet now, you can tell me what I should be counting as debt and what I shouldn't. I'm going to argue that if the defining features of debt are contractual obligations and failing to pay them results in loss of control, then all interest-bearing debt clearly meets the test. So it's short-term, long-term, corporate bonds, bank loans are all debt. You're saying, what wouldn't? Here are the gray areas. Accounts payable and supplier credit are liabilities. You owe that money. But the interest expense on those liabilities is often not explicit. You're saying, what are you talking about? Think of how you get supplier credit. You take supply of an item, and the supplier says you can pay me now or you can pay me later, right? But the supplier is not stupid. To get you to pay now, he often offers you a discount. So the interest rate on supplier credit is actually the lost discount that you gave up because you chose not to pay right away. If you're willing to make that implicit interest expense in an explicit one, you can treat supplier credit as debt. You know how difficult that is to do? That is why often accounts payable and supplier credit don't get treated as debt. It's not because they're not liabilities, but as long as the interest expense on them is not explicit, you have to treat them as part of working capital and show it in the cash flows. Increasingly over the last decade, perhaps the last 15 years, both GAAP and IFRS have required companies to bring onto the balance sheet underfunded pension obligations. What are those? If you have a defined benefit plan, you're supposed to set aside money to cover your obligations. And if you haven't set aside enough, in many parts of the world, you now have to show that as a liability. So you're saying, should I treat that as debt? It depends on the part of the world you're in. In the US, for instance, you have to show it on your balance sheet, but for informational purposes. There's no requirement, contractual or otherwise, that you have to come in with cash flows to cover that obligation, that underfunding. So in the US, I don't treat underfunded pension or healthcare obligations as debt. There are other parts of the world, especially in Europe, where if you have an underfunded pension obligation, you now have to come up with money in the next 5 or 10 years, legally and contractually, to cover that underfunding. There I would treat it as debt. Gray areas, but make your best judgment. So let's see what debt across the world looks like. What I've done in this table is actually looked at dollar debt by parts of the world and then broken down debt on a bunch of different criteria. I've looked at what percentage of the debt is short-term and what percentage is long-term, how much is secured and how much is unsecured, how much is fixed rate and how much is floating rate. There are some interesting patterns that show up. Japan, for instance, has the most unsecured debt in the world, 90.44%. I don't know why. Maybe in Japanese companies, Japanese banks lend, they don't care about security as much. By the same token, if you look at short-term and long-term loans, you notice that there are far more short-term loans in parts of Asia, especially Southeast Asia, not including India and China, and in India as well. So Asia has a lot more short-term debt than you see in the US. When you look at fixed rate and floating rate debt, again you see Africa and the Middle East has a much higher proportion of floating rate debt, and so as does India. Now, whether that reflects the high volatility in interest rates there or just historical precedent, I don't know. But there are some interesting differences in debt across the regions. But let's now carry this to the next step. One of the interesting questions about debt is, how much debt is too much debt? How do we know how much debt a company has? What do we measure a debt load with? One simple measure is to look at debt as a percentage of overall capital. Overall capital is debt plus equity. You can ask, what percentage of that capital is debt? And again, you can measure capital using either the accountant's measure book and equity, of debt and equity, which is book value, or the market's measure, which is market value. In this graph, I've looked at debt ratios, debt as a percent of overall capital, using book and market ratios, and then I've looked at differences around the world. And you can already see why, if you have a prior, you're trying to tell me a story about debt where you feel strongly that companies are either borrowing too much or too little, you can pick the number in this table that best backs you up. Let me take the US as an example. I've been reading a lot of stories about how US companies are getting over-levered. They're borrowing way too much money. Well, that might or might not be true, but let's play a game. Let's assume that you believe that strongly, that US companies are borrowing too much. You know what number you're going to latch on to back that up? You're going to look at debt as a percentage of book value and say, hey, I told you so. Look, across the world, the US companies have the highest debt ratio as a percentage of capital using book value. But if I wanted to push back, guess what I'm going to use instead? I'm going to say, hey, that's not true. As a percent of market value, the debt doesn't look too bad. You're saying, what does this mean? I would say everybody has an agenda when it comes to the debt argument, and the numbers they use will back the agenda. So unless you know what the agenda is, don't go along until you've looked at what they're pushing towards. Now, the other way I can measure debt load is to look at debt relative to earnings or cash flows. So in this table, I've looked at debt to EBITDA. And remember, the more debt you have, the higher the debt to EBITDA will be. The other ratio I look at is called the interest coverage ratio. It's operating income divided by interest expense. And here, the more debt you have, the lower this ratio should be. So if I believe these numbers and I look across the world, Eastern European companies look like they're the least levered companies on a debt to EBITDA basis. And they have very good interest coverage ratios. But if you look at the US, for instance, on a debt to EBITDA basis, it looks very similar to the rest of the world. And an interest coverage ratio, again, it doesn't, in fact, it looks pretty average. So if your argument is US companies are borrowing too much, I think you need to put some teeth in that argument. Okay? So because neither of these tables seems to back it up, and unless you want to latch on to book value and put your faith in book value, I see it's very difficult to make that case. So essentially, this table again looks at difference in debt loads around the world. Now let's talk about operating leases. Operating leases are what I call the accounting netherworld. Let me describe how a lease contract is written, and then you use the definition of debt I gave you to tell me whether it's debt or not. If you enter into a long-term lease, you've agreed to make lease payments every year for the next X years, 10 years, 12 years. It's a contractual obligation. And if you fail to make that lease payment, you will lose that particular leasehold when you fail to make the payment. Hey, if contractual obligation, failing to make it leads to a loss of control, this seems like a no-brainer to me. Lease commitments are debt. But for decades now, accountants have had this strange rule where if you don't own an asset, no matter how long your commitment is, how big the commitment is, that they shouldn't treat it as debt. The argument here is it more like unsecured debt or secured debt? That's a reasonable argument, but it's not an argument about whether it's debt. But for decades now, this has become the world's biggest source of off-balance sheet debt. Now, even accountants come to their senses sooner rather than later. And in 2019, they are going to make the change. But for 25 years, I've been doing this on my own. Why? Because I can't wait for accountants to do the right thing. Because converting lease commitments to debt is not rocket science. Here's what you need to do. First, you need to estimate a pre-tax cost of debt for your company. Why pre-tax? Because your lease commitments are pre-tax. You've got to match it up to those lease commitments. Second, you have to find those lease commitments for the future, and U.S. companies have been required to show this for the next 5 years and beyond year 5 as a lump sum. So I'm going to discount each of these commitments back. So these are already contractually set commitments. I'm going to discount them back to today using the pre-tax cost of debt as my discount rate. The sum of the present values of my lease commitments is the debt value of leases. Incidentally, that lump sum lease commitment beyond year 5, what I do is I spread it out across time based on what my typical lease payments look like for the first 5 years. So if $100 is my average lease commitment for the first 5 and my lump sum in year 6 is $600, I'm going to act like it's 6 years of $100 each. I'm going to discount them all back. I'm going to come up with the present value. That is the debt value. I'm going to put that on my balance sheet as debt. The balance sheet has to balance. So on the other side of the balance sheet, I'm going to create a counter asset. And now things get tricky. If I have an asset, I have to depreciate it, which effectively means that I have to redo the income statement. What you see as your stated operating income, remember, is after operating lease expenses. And now that I've chosen to treat it as debt, I'm going to redo the operating income by adding back the lease expense for the most recent year and then subtracting out the depreciation that I've had on the leased asset. You're saying, what a pain in the neck. I agree. But for 25 years, I've had to do it because accountants have refused to do this for me. Finally, in 2019, change is coming. Both IFRS and GAAP are going to start treating leases as debt. So in typical accounting fashion, it's going to be a lot more convoluted than the process that I described, but it's going to end up with debt showing up in balance sheets. There are some investors, analysts, and CFOs who are freaking out about what this will do. I think they're overdoing it. In this table, for instance, I've actually computed four numbers before the adjustment and after to see how it's going to play out. First, I took the total debt and I then converted leases to debt and looked to see what percentage change you're going to see when you convert leases to debt. And you can see that you're going to see a bigger change in debt in the EU and the environments than you are in Africa and the Middle East. The UK is going to have the biggest impact from this change. Now, actually, Australia is you're going to see a big jump in debt when leases are capitalized. Why? Because you have different groupings of different sectors concentrated in different parts of the world. I have a table that I've attached to this session where you can see how the lease effect is going to vary across industries, but you can see differences across regions. I've also computed 4 ratios. Debt as a percent of market cap, debt as a percent of book cap, with the reported numbers for debt and leases adjusted for debt. And I've also computed what the operating margins will look like before and after the adjustment, as will the return invested capital. In return invested capital, remember the operating income is going to be different, as is the invested capital. So both numbers are going to change. So the returns on capital are going to change. Looking across industries, though, there are some sectors where you're going to see much bigger impacts than others. In this table, I've looked at US companies. Why just US companies? Because US companies have the most consistent rules and reporting on disclosing lease commitments. I could do the whole thing for the world, but there are parts of the world where companies don't even disclose their lease commitments. And in the US, I've listed the 10 sectors where you're going to see the biggest percentage increase in debt when you capitalize leases. And not surprisingly, retail companies show up, in multiple places there. And I also looked at the 10 businesses which are non-financial. Almost all of the tables here, I've kept financial firms out of the mix. Because for financial firms, debt is really not a source of capital, it's raw material. I'll come back and do another post just on financial service firms, but the tables in this particular post, in this particular session, are with just non-financial service firms. So here are my final thoughts on debt. I think the biggest problem with having any rational discussion in debt is the emotional baggage we bring to the discussion. We have priors about debt that are so strong and so deeply held that we look for numbers to back it up. Debt is not the poison that some detractors make it out to be, nor is it the nectar that its biggest promoters describe it to be. It is, for better or worse, a source of capital, nothing more, nothing less, with fixed commitments instead of residual commitments, and a risk of default. It is good for some companies and bad for others. There are some companies and investors out there, especially in the leverage space, that I think overestimate its benefits and underestimate its costs. But they will learn the lesson the hard way. They will, the truth will catch up with them. At the other extreme, there are companies and investors who are very prudent, who feel that the best thing to do is have less debt over more, and actually have no debt at all if that's possible. And I think they're leaving money on the table. For whom? For the government. When debt creates value, it is because the tax code is tilted towards it. So I hope you found the session useful, and thank you very much for listening.